Last week, we spent time talking about concentration in markets, in stocks, and in how much influence a small group of companies can really have. This week, we're zooming out with a wider lens. Because once you understand that the market isn't just one thing, but a collection of many things, the next step is realizing that the economy isn't either. Headlines love to compress everything into a single story. The market is volatile, or inflation is cooling, or things are getting better or worse, depending on the day. But reality is more nuanced than that. Different indexes tell different stories, different sectors experience volatility differently, and economic shifts don't happen all at once. I'm Christiana Lovelace. I'm a licensed financial advisor and accredited asset management specialist, and I own Diamond Point Financial. Pointe Perspective is a weekly discussion where I help you put structure around all of the financial noise out there. Today, we'll talk about how indexes like the Dow and the Nasdaq shape the way volatility gets reported and why that doesn't always reflect what's actually happening beneath the surface. We'll build on last week's inflation discussion by clarifying the difference between disinflation and deflation and why confusing the two can lead to poor expectations and bad decisions. Then we'll move into strategy. How understanding cash flow, saving order, and tax planning allows you to build a system that's designed to work over time. Because clarity doesn't come from reacting to headlines, it comes from understanding the framework behind them. You've probably seen headlines about the Dow hitting 50,000 for the first time. Now, if you know what that means, great. But if you don't, I'll help it make sense. The first thing you need to understand is that the market is not just one thing. Most of what we hear is based on indexes, and different indexes tell very different stories. An index, put simply, is a measurement tool. It tracks a group of stocks to give us a snapshot of how a specific segment of the market is behaving. Last week, we talked about the S&P 500, which tracks 500 of the largest publicly traded companies in the US, and it's generally considered a broad representation of the overall market. But that's not the only index people reference. You'll often hear people talk about the Dow and the Nasdaq. The Dow tracks just 30 companies and is price weighted, meaning that higher priced stocks have more influence on its movements. It tends to reflect more established traditional businesses across sectors like industrials, healthcare, financials, and technology. The Nasdaq, on the other hand, is heavily concentrated in technology and growth-oriented companies. So right away, depending on which index you're looking at, you're viewing the same market environment, but through two very different lenses. That's why perspective matters. A lot of the volatility people are reacting to right now is not evenly distributed across the market. It's concentrated, largely in technology stocks. Because tech companies make up such a significant portion of the Nasdaq, sharp moves in that sector tend to get amplified. And anytime you hear growth-oriented, I want you to think fluctuations, because those two tend to go hand in hand. This is also why certain headlines feel more dramatic than reality underneath them. If someone wants to generate fear, they're not going to lead with balance, they're going to lead with volatility. Indexes like the Dow and especially the Nasdaq move more sharply, which makes them easy tools for emotional headlines. But drama doesn't equal accuracy, and it certainly doesn't paint a full picture of what's happening in the broader market. As one sector recalibrates, it's easy to mistake sector volatility for systemic risk, but those are two very different things. True systemic risk is rare and almost never discussed accurately in real time. So when you hear headlines about market swings, I don't want you to panic. I want you to slow down and ask, which index is being referenced? What sectors dominate that index? And is this volatility broad-based or more isolated? Maintaining that perspective doesn't remove risk, but it helps you understand it more clearly. That clarity is what helps keep short-term noise from turning into long-term mistakes. Last week we discussed inflation, and this week we're going to build on that conversation because this is where a lot of confusion creeps in. And I use the word confusion intentionally because some of the information being shared is just downright incorrect. The first thing we have to understand is that prices slowing down is not the same as prices going down. That distinction matters more than people realize. Inflation doesn't just flip from bad to good overnight. When inflation slows, that's called disinflation. Prices are still rising, but just at a slower pace that's more manageable and predictable for consumers. And that's typically what policymakers are trying to achieve. Disinflation is not a crisis, it's a transition. But deflation is something very different. Deflation is when prices broadly move down. Now, as consumers, that might sound appealing at first, like, hey, prices are cheaper. But deflation usually signals weakening demand, slowing growth, and increasing economic stress. From a behavioral standpoint, when people expect prices to be lower tomorrow, they delay spending today, and that causes spending to slow. When spending slows, businesses pull back, then hiring slows, and layoffs increase. This is where deflation becomes especially dangerous because falling prices can actually make existing debt heavier in real terms. Consumers, businesses, and governments all start to feel more pressure at the same time. And that's why economists and policymakers worry far more about deflation than they do about disinflation. Falling prices are often a sign that something in the economy is breaking, not healing. And this is why it's so important to separate what feels good in theory from what actually supports long-term economic stability. Slowing inflation allows households and businesses to recalibrate, but deflation creates pressure that compounds. And once again, this is where context matters more than headlines. Understanding whether we're experiencing disinflation or deflation helps you interpret economic signals more accurately without overreacting to surface-level narratives. Which brings us to the bigger picture. To be able to estimate what comes next, you have to understand where we are in the economic cycle. Economies move through phases: expansion, peak, contraction, and trough, and each phase behaves differently. Knowing those cycles allows you to think and plan more strategically in a way that most people simply are not equipped to do, in the markets and in your everyday life. So that's what we'll focus on next week. Now that we've talked about inflation, purchasing power, and how money moves through the system, let's talk strategy. Last week, we discussed building awareness around your spending and your cash flow. The question most people ask next is actually the wrong one. They usually ask, how do I save what's left? And the problem is, for most people, there's never anything left. Most people calculate their spending, bills, and discretionary first, and then they try to figure out how to save whatever remains, which is exactly why saving never becomes consistent. That's not a discipline problem, that's a structure problem. So here's how you make the shift. You don't save what you can afford. You spend what you can afford after you save. When you hear people talking about pay yourself first, that's exactly what they mean. It's not about the amount, it's about the order. Even small amounts done consistently could grow into real wealth over time. First, decide how much you need to save, whether that's for retirement, emergencies, or future goals, and treat that savings like any other non-negotiable expense, just like rent, utilities, or insurance. Once savings happens first, everything else will adjust around it. And that's why the cash flow we talked about last week becomes so important. When you understand where your money is actually going, you can decide intentionally what gets prioritized. Paying yourself first removes the emotion from the process. You're not constantly debating whether you should save this month or reacting to what's left over because it's already been decided. And when you pair that decision with simple automation, saving can happen consistently without relying on willpower or imperfect discipline. This is how control is built in a modern financial system, not through restriction, but through structure. And when structure is in place, consistency follows. On the topic of strategy, let's talk about taxes because this is another area where expectations often don't match reality. Most people think tax planning is something you can fix in 1 year, and sometimes that is all it takes. Put some money over here, adjust this, tweak that, and it's done. But that's almost never how it actually works, especially in more complex situations. In most cases, becoming more tax efficient is a process, and for many people, it can take a few years to really feel the impact. The first year is usually the hardest. That's the year where you become aware of how your income is taxed, where your deductions actually come from, and what options you do and don't have available. The second year tends to get a little better. That's when things start to align. You make adjustments, you put structures in place, and you stop reacting to it just at tax time. And by the third year, you have a foundation. That's when tax efficiency starts to feel more consistent and manageable. Tax strategy is not about avoiding taxes in one dramatic move. It's about building a process. Over time, that process creates structure, and structure allows you to make smarter, more intentional decisions. Notice a pattern yet? This is how real financial planning works, laying a foundation years in advance that creates opportunities and options for you and your family in the future. As we wrap up, I want you to keep a few things in mind. Volatility isn't random, inflation doesn't reverse overnight, and good financial decisions aren't made in isolation. It is never as simple as it seems, and it almost always requires context. Now, next week, we're going to take these ideas a step further, because to really understand what comes next in the markets, in the economy, and in your own financial planning, you have to understand where we are in the economic cycle. Those phases shape behavior, opportunity, and risk far more than any single headline ever will. I hope today helped put these important topics into perspective. Until next week, take care.